Alright gang, welcome back. This is chapter 3, part 2. So what you're looking at here is really just a breakdown of what adjusting entries and accruals are. By the way, this is your handout for chapter 3 today. If you look on Web Campus on the front page, you'll see the link to the handouts. Real important that you found that by now. But check out chapter 3. This will be one. And it's only important in that it breaks down this chapter into its 4 components and really what we'll be learning here. And the second handout is actually part of number 1, a subset of number 1 here. So we're going to be learning these 4 types of adjusting entries and accruals. Really, it's the top 2 are adjusting entries and the bottom 2, number 3 and 4, are accruals. And I'll explain what the differences are. So no need to try and understand them just yet, but let's start with number 1, prepaid expenses. And I've already made a little bit of reference to these, and you've had a little bit of exposure to prepaid expenses in chapter 2. But what that means is our company has paid out cash, and we've gotten some sort of an asset, but we haven't reaped all of the benefits yet. However, what an adjusting entry is a journal entry that happens not because a business transaction has happened, but because of the passage of time we have used up some of those benefits. So our books or our financials need to reflect the fact that we have used up some of those assets. So let's go ahead and take a look. There's 3 different kinds of examples under prepaid expenses that we're going to learn. Number 1 is the very simple prepaid expenses we've discussed before, then supplies, and then the third one, which is a little bit of a subcategory here because it is a bit complicated, is depreciation, and that'll be your handout, slide number 2 from your chapter 3 handouts. So let's go ahead and jump into prepaid expenses first. And we're going to start with an example, of course. So prepaid or deferred expenses. And so let's assume that the date is December 1st, 2011. Okay, it's the 1st of December, meaning we've only got 31 days or 1 month left in the year. That's really important, okay? And let's assume that our company puts out its financial statements at the end of every year, December 31st. So fast forward, paid $2,400 for insurance for 2 years, the next 24 months, right? Starting December 1, immediately we're going to be insured for the next 24 months, so the next 2 years. December 2011 through November of 2013. So what's the original journal entry when we pay out this $2,400 cash? Real simple. The way I like to think about it is, of course, is cash involved? And if so, is it going up or down? And that usually leads you to the at least half, getting the answer half correct, right? Or at least half of it correct, and you can figure out the other half. So we know our company's spending $2,400 cash. To show a reduction in cash, we credit cash. Every asset to show a reduction, we credit it. So we'd be crediting cash $2,400. Now, was it an expense? Is this an insurance expense? The answer to that question is, first, you got to ask another question. Have we used up everything as of December 1st, 2011, when we spend that $2,400? Have we used up all the insurance premiums at that point? Or are we prepaying for insurance for the next 2 years? Do we own something now, an insurance policy that covers our business for the next 24 months, something that we will reap benefits for in the future? It's obviously the latter here, right? We're buying insurance, a premium that we now own the rights to for the next 24 months. If something happens to us, our insurance company has to pay for the next 24 months. We own something. So we're crediting our cash to show that our cash has decreased, but we're getting another asset in exchange for this. So the original entry that we would record is prepaid insurance. Remember, that's December 1st, 2011. Now, keep in mind, this is $2,400 that we have paid, right, for 24 months. So once we post this journal entry to the actual accounts, this is what it would look like. We would be debiting our prepaid insurance account for $2,400. And of course, we'd be crediting the cash account for $2,400. But let's stay focused on this prepaid insurance, this new asset, this thing that our company owns, okay? Owns a $2,400 asset now that will provide our company some benefits in the future. On December 1st, that's true. We own an asset called prepaid insurance that's worth $2,400, right? Basically $2,400 for 24 months. I've done that on purpose in this example. I've made the math really easy. It's basically the insurance premium is $100 a month, and we're prepaying $24. Now that's true on December 1st. If somebody were to come ask us, hey, what is this asset prepaid insurance really worth on December 1st? It is worth $2,400. But what's it worth 1 month later? If we use up, right, we're insured for the month of December. At the end of December, we've used up 1 month of this asset, right? We no longer have an asset worth $2,400. And if we were to go put our financial statements out there and say, hey, we own this prepaid insurance asset that's worth $2,400, we'd actually be lying and misleading the public or our investors or our owners or whoever it is, our bankers, that we're showing these financial statements to, because we've used up 1 month of it as of December 31st, right? So I want you to think about how would we show that this has been reduced by 1 month's worth. So let's fast forward now. Sorry to use that. I know that's the name of our company. But on December 31st, we have to adjust that asset to its proper value, right? To show that we've used up 1 month worth of insurance. And the way we do that is, of course, we need to reduce that prepaid insurance account by $100. The way we reduce an asset is, of course, we credit it, right? We debited it when we first purchased it. Now we've used up 1 month's worth, we've got to credit the prepaid insurance account. And now that we've used up that asset, it's time to recognize an expense. And of course, it's an insurance expense. That's what I don't care too much about the terminology here, but names of expenses are going to be fairly simple and straightforward for you to figure them out. For now, I just want you to understand that we are reducing the asset by $100 and finally recognizing the expense, because as of December 31st, we've now used up 1 month's worth. That's why we don't recognize it up front. We got ourselves an asset. So when we post this journal entry or this adjusting entry at the end on December 31st, the end of the year, we'd be crediting the prepaid insurance account by $100. And now the balance would be $2,300. So the next step for us, just like in Chapter 2's homework, would be to prepare a trial balance, right before we put out our financial statements. And now on December 31st, when we go tell the world, hey, we've got prepaid insurance, an asset that's worth $2,300. We are telling the truth. We're not overstating our assets, and we're not overstating our net income because we've properly recognized our expense of $100. So understand that adjusting entries don't happen because we've spent money or anything specific has happened on December 31st. It's just that the passage of time will require that we adjust certain accounts, right? When we first purchased the insurance, we did spend cash, and we in the accounting department would likely see a source document like a check, right? Or a bill from our insurance company that's for $2,400. We say, hey, looks like our company incurred a $2,400 payment, but not an expense. On December 31st, there'd be nothing. We just have to physically get up and have reminders as the accountants know that we have to start figuring out adjustments and accruals at the end of the year. And that's what's unique about adjusting entries and accruals, is usually they're not brought about by any business transaction the way regular journal entries, like what you worked with in Chapter 2 homework, is all about. Alright, supplies also works kind of the same way, but these are actually physical things that our company purchases. So let's assume during the year, in 2011, our company, fast forward, purchased $9,720 of supplies with cash. And I want you to go ahead and write that down, $9,720, or put it in your phone, something so that you can remember. Throughout the year, in fact, let's just say they did it early on in December 2011. We had no supplies, and we went out and bought ourselves, let's call these office supplies for now, $9,720 worth of office supplies, and we put them in our office supply closet or cabinet, right? If we bought those with cash, what would the journal entry look like, of course? If our company's spending cash, right, we're going to reduce our cash, and we reduce assets with a credit. So we credit cash by $9,720, and we are getting an asset called supplies with a cost of $9,720. So we would be debiting the supplies asset account. And that's what it would look like on, not December 31st. Forget that is there, people. That should actually be December 31st, perhaps of the earlier year, or let's call that January 1st. Just use your imagination for me here. All right, so we bought those supplies. We would, of course, post that amount into the supplies account. And if anyone looks in our supplies account now, anytime during 2011, we've got $9,720 worth of supplies. But now let's fast forward to the end of the year, right? It's December 31st, 2011, and we send our minion into that supplies cabinet to do an inventory count, right? He goes in there and he counts the supply cabinet, and there's $8,670 worth of supplies, or what we call remaining on hand, okay, at the end of the year. So how many supplies did we use up during the year? And that's real easy to figure out, right? We purchased 9,720. We now have $8,670 remaining. So how much supplies did we use up during this period? And it's $1,050 worth of supplies, right? We had 9,720. At the end of the year, we only have $8,670. So we need to reduce our supplies account by $1,050 to show that we use those up. And of course, to reduce an asset like supplies, like any other asset, we credit it. So we would be crediting the supplies account, and of course, just recognizing that we've used up an asset. When we use up an asset, it's called an expense. So it would simply be a debit to supplies expense. And once again, no business transaction has happened. No one's come in and said, hey, we used up $1,050 worth of supplies. We just know that at the end of the year, we need to go take an inventory count. And don't worry, you and I will be sitting in our fancy lead accountant's chair, earning the big bucks, living the good life. We send our minions in there to go do the inventory count. So remember, we want to take a look at what the inventory or what the supplies were originally, right? Then take account of what they are at the end of the year, and the difference is what we've used up, and we will need to reduce our supplies account. Otherwise, we'd be lying if we put out financial statements at the end of the year and said, hey, we've got $9,720, we own $9,720 worth of supplies. That's not true. We've used up $1,050, and we only have $8,670. And by doing this adjusting entry, we automatically, and posting that, of course, to the general ledger accounts, we get our accounts to show the proper balance. Supplies now shows $8,670 worth of supplies, which is exactly what our minion went in there and counted. So that's why we're doing an adjusting entry. Remember, the original entry when we purchased supplies, that was a business transaction. This is more of an adjusting entry, just to get our assets and expenses to their proper amount at the end of the period. Really just with not the passage of time, but using up. All right, let's stop this video here, and we'll take up again at part 3, where we'll get into depreciation. Remember, this slide that we're looking at is handout number 2 for chapter 3, and we'll come back in just a moment on part 3 of chapter 3.